This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 309 was recorded on February 3rd, 2022. I'm Erik Townsend. This episode is brought to you by Abaxx Technologies, pioneering the design of smarter markets that better serve the needs of both market participants and society as a whole. And by Masterworks, the billion-dollar alternative investment platform that lets you invest in art by legends like Warhol and Picasso for a fraction of the cost. Financial Times Alphaville's outgoing managing director, Izabella Kaminska, joins me as a first-time feature interview guest. Izzy and I will discuss everything from inflation to sustainability of Uber and AirBNB's business model. Then be sure to stay tuned for our Postgame segment when Patrick's chart deck is titled Update on the Bond Markets.
And I'm Patrick Ceresna. Erik, let's jump to that S&P 500. It's been a pretty strong week, almost 4 straight up days, and then today giving some back in the post-Facebook news. What's your thoughts on the markets here?
Well, Patrick, just as you told our listeners to expect last week, right through Tuesday of this week, boy, it was so tempting to just interpret that chart as, boy, look at that, V-shaped recovery, here we go on our way to all-time highs once again, because, of course, that's the way this market has played for the last several years. And, of course, just as you warned our listeners, as soon as we got back up to that 100-day moving average, boy, the market found a little bit of resistance. Now the big question is, okay, does that mean the dead cat bounce is over and we're headed to new lows below 4,200? Or does it just mean we're taking a little pause here before we get through this resistance and really do climb back up to new all-time highs? I'm going to say that there's plenty of possibility for either scenario. I'm leaning toward more turbulence and potentially more downside here. I don't think anything has been resolved. Now, yeah, we had a little bit of an oversold reaction to the Fed, but none of the factors that led us into this have changed. So I don't see any reason to expect the V-shape all the way back to all-time highs. But then again, every single time that I've thought we finally had a bear market upon us for the last 10 years, we saw the beginnings of one, then it just retraced right back up to all-time highs. So we'll see what happens, but I think this one maybe has some more potential to the downside.
I have to agree. We'll pull it up in the post game on a chart and talk about what's next for the markets. All right, so let's move on to the dollar index. A little bit of a breakdown today, but it's really more about the ECB and the Euro news that I think moved it. What's your take on the dollar here?
Well, as I explained last week, that break over 97 was a knee-jerk reaction to the Fed's statement. So the question was, is it going to hold? And that was the question that we posed last week. Answer, it didn't. Now, at this point, the question is, does it get back up there? I think we're in an era of dueling central banks. And as we see a number of nations' different central bank policies roll out, it's all a moving target. So I don't know what's going to happen next, but I think it's noteworthy that that breakout over 97 was, in fact, just a knee-jerk and did not last.
All right, let's get an update on crude oil. OPEC meeting was yesterday. What's your take on how everything's played out?
Well, on inventory, crude oil drew down 1 million barrels, Cushing, Oklahoma drawing down 1.2 million barrels, gasoline building 1.3, distillates drawing down 2.4, with U.S. production ticking down 100,000 barrels to 11.5. But as you said, the real tape action this week was on Wednesday morning, but it wasn't a reaction to inventory. It was a reaction to OPEC Plus basically saying no change. They're going to go ahead and do exactly what they told everybody they were going to do months ago, which was to increase production by another 400,000 barrels per day, exactly as planned many weeks previous. There was some speculation that the Biden administration might be able to influence them to increase production even more than that. Now, I think there's actually a hidden story nobody's paying attention to yet, and it might be because that story is not yet in play. I'm not sure if it's in play yet, but someday, not too far in the future, we're going to get to the point where the White House is saying, you know, OPEC, you guys have got to increase your production, and they're acting cool, saying, yeah, we could if we wanted to, but we're not going to because we're OPEC. What will really be going on is OPEC knows that they're out of spare capacity, and they don't want to admit it because admitting that basically undermines all of their power to negotiate. I don't think OPEC has nearly as much spare capacity as a lot of analysts think. So at some point, I think what happens is we get to the point where all the OPEC countries are pedaling as fast as they can, and they still can't make enough oil, and we really get to upside price pressure. And guess what? We, thanks to this misplaced interpretation of ESG, all of a sudden it seems to be against the rules to invest in new exploration and production companies. So we're going to have a real crisis on our hands, I think, in coming years. In any event, Patrick, up at these lofty levels, there's plenty of room for a very significant pullback. That could either be on some kind of news, such as a de-escalation of tension between Russia and Ukraine, or Russia and Ukraine and the United States fanning the flames, as the case may be, or whatever else. But eventually, as we work through this, I think we're headed north of $100 before 2022 is over, probably above that number into triple digits by summertime.
All right, let's touch on gold. Obviously, it gave back off of its highs. We're pivoting 1,800 here. What's next for gold?
Well, as we said last week, Patrick, we knew that what we were seeing last week was a knee-jerk reaction to hawkish Fed policy. And I said it's overdone, and probably there's going to be a bounce back over this, but the question is how much of a bounce. And sure enough, we've seen a bounce, but it's only a muted bounce. We got back over 1,800 a little bit. It looks like 1,804 right now on my screen. I don't know if that will last through the end of the day. We traded much lower earlier in the day. And now that big cluster of support that was under the market is resistance above the market. So we got to get through that cluster of resistance again. And at the end of the day, Patrick, I think we still have to revisit the fundamental drivers that were supposed to take gold to all-time new highs. They did happen for the most part. Now, on the other hand, we know from Ronnie's slides last week that the beginning of a hiking cycle is sometimes when gold really starts to take off. So maybe as we get into this hiking cycle, we'll see some upside. But for now, the challenge is to get through that big cluster of resistance and back above 1830.
All right, and let's wrap with touching on the 10-year Treasury yield, which has really been overall non-responsive in the last month or so. What's next for the yield?
Well, Patrick, I really don't have anything to add since last week. I think that we're at a critical point here, and the question is inflation going to be proven transitory, or is it really secular, as I think it is? And even if inflation is secular, does that mean that rates have to back up, or do rates only back up if the Fed fights that inflation actively? It looks like they're not going to. So I really have no idea where rates are going. I'm watching them carefully. I think it's a very important time to be paying attention here, but I have no predictions.
Well, we'll talk about it when we get to some talking charts on the bond market in the postgame. Anyway, this week's featured interview guest is former FT Alphaville editor Izabella Kaminska. Erik, why did we invite Izzy on as a first-time guest this week?
Well, I've been following Izzy Kaminska for a decade now. She's one of the smartest analysts that I've ever come across. And when I saw that she was leaving Financial Times Alphaville, I kind of wondered what was going on. And the official story is unannounced. She's leaving FT Alphaville and she's doing something else, and it's not really clear what. It was only in the course of getting into this interview that I really figured out, and she didn't tell me this on or off the air, but my sense is that Izzy is tired of working for an organization that constrains how freely she's able to express herself. At one point in the interview, it almost felt like she was saying, oh, am I allowed to say that? So you'll see at the end of the interview, we had a little bit of fun with that. I really think that you're going to enjoy this interview, and I encourage you to follow Izzy's new blog, which I'm pretty sure is free. She is one of the smartest people I know, and it seems like she's got a lot to say and hasn't been able to say it under her past employer. So I'm looking forward to see what her blog brings us. And I think you're going to really enjoy this interview.
Erik's interview with Izzy is coming up as MacroVoices continues right after this message from our sponsor.
Abex Technologies invites you to Smarter Markets' new podcast series, Demystifying Carbon Markets. Corporate climate pledges went mainstream in 2021. Moving into 2022, these companies are increasingly focused on developing and implementing plans to turn their climate pledges into climate action and understanding how carbon markets can help them turn their good intentions into meaningful change. For many, however, carbon markets remain unfamiliar, creating apprehension over potential risks. They have many questions. What are carbon markets? What types of projects help reduce carbon emissions? How do I judge the quality of these projects? Will the carbon markets be large enough to meet net zero goals? In this series, Smarter Markets teams up with Base Carbon Corporation to bring you the architects and practitioners of the carbon markets, seeking answers to all of these questions from people who know the markets best. Episodes are available weekly on Saturdays beginning February 5th.
And now, with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me now is Izabella Kaminska, who many of you know as the managing director of Financial Times' Alphaville blog. Izzy actually just left FT Alphaville, and she is now heading up her own media enterprise, theblindspot.com. That's THE-blindspot.com, which is Izzy's new media venture. Izzy, it's great to get you on the show as a first-time guest. I haven't talked to you in years and years, but I've loved following your work on FT Alphaville. Let's talk about where we stand in the recovery from this massive coronavirus COVID experience that we've had. My view is that although I'm not a virologist and don't know these things, all the smartest people seem to be telling us that it's very likely that this Omicron strain is going to be what gets us from the pandemic phase to the endemic phase of this crisis, leading to reopening of the economy. First question is, do you agree with that general view? And if so, what do you think this recovery is going to look like compared to others?
Hi, thank you so much for having me on. Yes, I tend to agree with you that this is us moving into the endemic phase. Certainly, we can't go on suspending our lives as we have. We have to find different coping mechanisms. And luckily, Omicron has come along and proved itself a milder form of the disease. So that is great news for us. But at the same time, I think in Europe, we are still, there are many countries that are still very fearful and quite, the Netherlands is one of the countries that has been very late to drop restrictions. Denmark has recently dropped restrictions, but compared to the UK, they were locking down even over Christmas. So we stayed open pretty much. So there's still a very different approach. Like within Europe itself, different countries are still taking highly diverse approaches to dealing with Omicron. So yes, I agree generally that we are in the endemic phase, but I also think there is a risk that at any moment a new variant can come along and sort of bombard any intent to properly open up. And if and when it does, my personal view is that we have to really consider whether lockdowns are the best way forward, given the fragility of the economy, given the scale of the hit we've already taken. It might not necessarily make sense to do what we've done before.
Izzy, I want to credit you because when the phrase transitory came into popular use to talk about inflation, you were one of the very first people to publicly call BS on that term and say, look, in the right time frame, World War II was transitory. So what does this word transitory mean? It doesn't mean anything. Let's talk a little more about inflation. Clearly, you called, a lot of our best guests called a coming inflation. But I've got everything from a view from a few of our guests that says, look, the COVID crisis was the catalyst to bring about secular inflation that's going to last for 20 years. Other people are saying, look, it's completely wrong to think about it that way. What's going on here is we've had massive supply chain disruptions because of the COVID crisis. As soon as those supply chain disruptions are cured, the inflation's going to go away, and the disinflationary forces of demographics and debt and so forth are going to take over again, and this inflation really is going to have been transitory. So which is it? Are we embarking on a journey toward a new era of, like the 1970s, a secular inflation, or is this a blip that's about to end?
So I tend to agree with the former perspective. I do think the term transitory itself is a massive misnomer. I think it misrepresents the whole concept of inflation. Inflation can and always was transitory. I mean, that's the whole point. Inflation is a signal from the markets that something is misaligned and that we need to take different approaches to sorting out, whether it's the way the economy is run, the incentives, or, access to different goods and, or maybe even our political systems, right? So whether the inflation lasts, a year, whether it lasts 7 years, doesn't really make a difference. It's still an inflation. I think that doesn't, I'm of the opinion that this is just semantics, right? So in terms of how the inflation, how we treat the inflation and whether it's meaningful that it's a supply chain fueled inflation, again, I'm kind of ambivalent to, whether it's a supply chain issue or not, because fundamentally inflations can be demand led or supply led, right? So either way, the problem is not enough resources or goods or products on the ground and too much money circulating in relative amounts. So the fundamental problem in all inflations is that there's a shortage of goods and people are chasing, their money is chasing an ever smaller amount of goods or products or services. And that's why the prices go up. And until the balance is restored, the inflation is going to be ongoing. Whether it's a supply chain issue, I think is an irrelevance. The point is that in an inflation, it's a market signal to make more stuff. We need more stuff relative to the amount of money that is circulating around. And yes, you can also apply a monetary perspective and suck some of that extra cash out of the system with higher interest rates, of course. But fundamentally, that doesn't necessarily address the velocity question in the money circulation side of the equation. And I'm Polish, so I'm massively influenced by the sort of inflations of the Soviet Union, which were also supply chain, catalyzed. You don't look at the Soviet Union and say, oh, well, their inflation problem wasn't really an inflation problem because it was a supply chain issue, do you?
Let's talk more about supply chains, because it's a subject that you've written quite a bit about in this crisis. Help me understand, the big thing that seems to be really screwing things up right now is the shortage of computer chips, semiconductors. Now, hang on a second. Semiconductors get manufactured in big, very carefully climate-controlled factories. It's not like a meat packing plant that has a huge infection risk for, in the middle of a global pandemic. So this is not about something about semiconductors being hard to manufacture when there's a virus there. It's actually about something else, where those semiconductors are being manufactured and how those supply chains are being effective. What's going on here? Why are we having these big supply chain disruptions in semiconductors?
Well, first of all, I find it extraordinary that there wasn't some sort of, someone in government in the sort of national security side of things or in the resilience planning side of, I don't know how, all sorts of weird departments exist that are supposed to be thinking about risk, right? I'm surprised that nobody saw this coming. I'm surprised that we allowed the market to get to a situation where a huge percentage of the world's supply of semiconductors is made in one country by one company mainly, and that's TSMC. That feels very much like a blind spot that manifested, and I don't know why the market allowed that to happen. I still haven't read a convincing analysis other than, competitive forces focused all the manufacturing in Taiwan, and that was their competitive advantage, and certainly, division of labor, etc. That was their thing. But this is where we are now. And from my understanding, one of the problems, people say, oh, well, this is a great incentive to diversify and to encourage the production of semiconductors here with you in the US or in Europe or elsewhere. But it takes a long time to bring a semiconductor plant online. And also you have to have the intellectual property and the capacity and the skill. And certainly it's not just about the manufacturing, it's also about having the talent to be able to deliver it. And whether all those variables exist is the big question. When this crisis hit, the first thing that came to my mind was the famous James Bond film, A View to a Kill. I'm sure you have seen it, because the plot line in that is Zoran, the bad guy, is trying to corner the world's semiconductor market, which at the time was in Silicon Valley. And he hatches an evil plot to wipe it out so that he can control and monopolize the market. Well, I kind of feel like we've literally lived through that and are still feeling the repercussions, but somehow we didn't have a nimble forward-looking James Bond character to come and rescue us from that situation. So, yeah, it's extraordinary to me. What can I say? But it does look like the supply chain crunch is easing now. TSMC has committed to, I believe they've committed something like 44 billion to increasing capacity. I've seen it myself, the semiconductor shortages that were causing delays in the new car that I had ordered. They've seemed to have overcome. The car is now on its way. So I'm hoping that this will ease in the next 6 months. And certainly, one of the other issues is geopolitical kind of exposure now, because if there is any, perhaps we can talk about this later, but the bigger risk now is not one of coronavirus impacting the capacity for people to go to work, but any sort of instability in the region.
Let's go ahead and talk about that instability. I assume that you're talking, among other things, about the developing situation in Ukraine. How do you read that situation? Does Russia really want war with Ukraine, or is it the United States that just likes talking about that scenario?
It's very hard to unpick. I think personally that the information space is now so polluted that it's very hard to know what the agenda of any particular party is. And that includes the US, it includes Europe, and it includes Russia. Certainly, there is a lot of evidence to suggest that Russia is going to move ahead and make an aggressive move. There is from what I understand, having looked at the reporting from the area, there is a lot of troops build up on the periphery and in Belarus, and there is a fear factor as a result of that. On the ground in Ukraine, reports suggest that there's a lot of the Ukrainian perspective is that perhaps the West is hyping it up a little bit, that there is some sort of agenda or incentive to talk things up, perhaps some war hawks wanting a new war to focus on after the end of Afghanistan. That sounds reasonable to me as well. I do think that there are certain forces or powers that benefit from an ongoing war scenario, and one has to consider the fact that it is this does follow in the footsteps of the US pulling out of Afghanistan. So the NATO fragility, I'm not personally a military strategist or in any shape or form a military expert or tactical expert, right? But it does seem that the issue is very clearly about NATO and its expansion, and Putin sees any expansion as a threat to his own power base and wants a guarantee that Ukraine will not join NATO. And I think that's the concession that increasingly looks like it will be made by the NATO forces and the US. So the question is, will the people of Ukraine feel vulnerable if and when that becomes explicit? What I've found interesting is in this world of political diplomacy, it's really when something implicit becomes explicit is usually the point where a flashpoint occurs. And that's why diplomacy is so subtle. That is why you can't say what you really mean. Everyone knows it, but until it's said explicitly, you can kind of ignore it. But once it's said, things can escalate very, very quickly. And so my concern really is what happens when the NATO situation becomes explicit.
Izzy, let's talk about the role of media in government and the perceptions that are being presented to the general public about these various different geopolitical situations. And I would expand it beyond just the Ukraine situation to also consider, the Chinese conflict with Taiwan and the question of sovereignty there and so forth. If I go back to growing up in the 1970s and 80s, it seemed like the role of both government and the mainstream media was to keep everyone constantly reminded of the risk. It seemed like, we had to remember that those Russians still had nuclear weapons. They could blow up the whole world. And if we didn't vote for Ronald Reagan's Star Wars, thing, we could all get blown up. Everybody be afraid. Let's all think about everything that could go wrong. It seems to me like both the media and the government are, if anything, completely underplaying this because, I'm not a military expert either, but from what little I know of it, I think the development of hypersonic weapons that have the ability to completely evade the missile defenses of the United States by China and Russia, and I'm told that both of them have those capabilities operational and functional today. They also apparently have carrier killer, specifically designed missiles, hypersonic missiles, whose purpose, they were designed for one thing and one thing only, which is to sink a U.S. aircraft carrier. And people actually have those missiles, I'm told. Nobody's telling me that I turn on the nightly news. Nobody tells me I should be worried about any of that stuff. If anything, it seems like just brush it under the carpet. Let somebody else worry about it. Let's not talk about it. Why is it that for some reason now, unlike the 70s and 80s, nobody wants to tell me that there are risks in the world that could lead, let's face it, to World War III? This is, real stuff. Hypersonic missiles that can sink U.S. aircraft carriers. That's a really big development. Nobody talks about it.
So I agree with you, and I think it's weird that we're not talking more about the World War III risk, as I call it. And I think it's a taboo. I think I almost feel like it's almost like,
you and I are going to be labeled as sensationalists and alarmists for just the hypothetical question. Why is it that we don't talk about these things? I'm going to be labeled on Twitter as an alarmist nutcase who thinks the world's coming to an end.
Right. And I agree with you. And that's my concern. And I think this sort of fear factor of like, what will people think, and not wanting to be labeled as X or Y is actually now preventing sensible analysis in this space, because as tensions escalate, I think it's very weird that we're not being more upfront about these risks. And certainly I can see a very strong contingent online who is very vocal about the fact that anyone who worries about these risks is some sort of, reds under the carpet person, or that there is, that we're bigging up a threat that doesn't exist. It's all in your head. I'm not a military expert, but I have read a little bit of Sun Tzu. And, the whole point, and I'm a classicist. I'm an ancient historian from, in terms of what I studied at university. And I wrote a piece not long ago about the concept of hybrid warfare. And I thought it was very interesting that in the last few months, that term has now become much more commonplace, because the whole point of hybrid warfare is that if you are using that as a tactic, your enemy mustn't realize they're at war. In fact, the later your enemy realizes they're at war, the better for you, because you have already disempowered them. And by the time they realize they've been attacked, they can't rally the troops and they can't defend themselves. They've already been massively demobilized, right? So anyone talking about that was seen as, like we said, an alarmist. But with the recent escalations on the Belarus border with Poland, I don't know how much you know about that, but there was, they got very, watching the footage, it was incredible to watch. There were these large people buildups of migrants, large migrant buildups on the border in the middle of winter in incredibly tough conditions. It looked like scenes from Game of Thrones, like in the old days when the different contingents would gather on the battlefield. So you had the Belarus side, and then you had the Poles, the soldiers on the Polish front clashing. It's not that they were shooting at each other, but it got hostile. They were raiding the border. The Polish troops were trying to, they were using water cannons and God knows what else to sort of keep the masses at bay. And the term that kept coming up over and over again was hybrid warfare. Lukashenko is using migrants as a cover for his actual political aspirations to destabilize Poland and to flood the European Union with these migrants. And what was interesting is that term then got normalized. And once it became normalized, people started asking themselves, well, if that's hybrid warfare, if that's the intention, if it's unconventional warfare, which is focused on like using tactics that make you not, delay the recognition that war is going on at all, then you have to see and consider the broader picture. And I think, having spoken to some experts in the field, one thing they say to me, which I find convincing, if alarming, is that there is a presumption very often that any war is going to look like the war you've just just fought, or the last war. But actually, every war has evolved just like technology has evolved. So World War I was very different to World War II in terms of the technology that was deployed and how it was fought. And then the Gulf War was completely different to the Vietnam War, the Falkland War, etc. Different variables, different geographies, different technologies. And we are now in the digital age. And I think it's very naive to assume that war is not going to go digital itself. And when you talk about, what really is a flashpoint, what really is an escalation, it doesn't have to necessarily be a troop on troop confrontation. It can be happening in cyberspace, and it has been happening in cyberspace. We've seen the scale of conflict in terms of hacking, in terms of disinformation, in terms of sort of obscuring the battlefield. Now, if the new war is going to be fought online, then frankly, I don't think it's hyperbolic to say that the new soldiers of the sort of cyber war are going to be professionals in information communication. So that means people like us, like journalists, like anyone who is a vocal presence online is going to be a member of that war. And some part of that is going to be people who perhaps don't realize they're in a war yet. And I think, okay, I'm really, truly hope this is not the case. But I think we have to, if you're practical minded and you're focused on finance, you're focused on what matters and how asset classes are going to move, and the geopolitics of everything, I think it is reckless to not consider that it is a possibility.
Well, Izzy, it sounds like you and I are in very strong agreement that geopolitical tension between the United States, Russia, and also China is very real and likely to increase. But as you just said, our job, as much as the real big issue there is a humanitarian issue, this particular podcast and our occupations is not humanitarian. We work in financial markets. How do we translate this view to what it means to investors and what it means to portfolio positioning? What wins and what loses in this environment?
Well, what I think is interesting is that in any, geopolitical or war situation, very often the clue that you're in war comes from the movement of asset classes and, the price increases in certain commodities or whatever. I think it was, I'm going to embarrass myself if any historians are listening. I think that was one of the clues that Churchill had, like that there was a big problem coming up in Germany. It was the buildup of resources and weapons technology and military equipment in Germany, right? So that is a market angle towards for any war situation, right? You want to know who is buying what resources, what they intend to do with them, how they're going to utilize them, how they're going to ensure that their populations are safe, right? So I think from a market's point of view, if you call the right, if you can see how these geopolitical tensions are likely to evolve, if you can predict those movements, then I think you can help, you yourself can benefit from calling the market right and realizing, well, gas prices are going to go up because it suits Putin's agenda to squeeze the European markets at a time when February is notoriously the best time to launch an invasion. I mean, it's always actually there's a mud issue, so just after February, but once the mud goes away, it's the ideal time to launch any sort of assault, a springtime movement. You don't necessarily go into war in whilst ahead of the bitter winter. You do it just after. But from a gas perspective, that's also when any stocks have been entirely used up, and when your enemy is potentially at its weakest, because it is highly dependent on your gas supplies. I mean, it's really not that complicated, I think. And as far as an investor goes, well, the price of oil, the price of gas influences almost every stock and every asset class out there, because energy is such a massive input into the global price of, everything.
Izzy, obviously, with the situation in Ukraine and tension with Russia, we have to think that there's a risk of energy prices going through the roof. And so if you want to speculate on that, long crude oil makes sense, although you're a little bit late to the party for that trade. Tell me a little bit more about this Taiwan semiconductor situation. I mean, it sounds like if either Taiwan wanted for some reason to hold the world at hostage, it could basically cut off the supply of critical semiconductors and really screw up the global economy. And to whatever extent China really has the ability to force the hand of Taiwan, they would gain that power. Is that true? And if so, what are people doing to mitigate those risks? Doesn't sound like a good picture to me.
Yeah, I think that is a risk. I don't think Taiwan would itself want to hold the world to ransom. I think it's been a very responsible market participant thus far, and a very, shown a lot of integrity, and there's no doubt in my mind that Taiwan would want to continue providing semiconductors to the world, right? The issue really is whether an encroachment by China would lead to a different balance, like we've seen in Hong Kong, where obviously now there is a big exodus of Western firms from Hong Kong due to the new not so friendly environment. Would a similar tension arise in Taiwan for foreign manufacturers, for foreigners, for anyone doing business with local manufacturers? I think probably yes. I think that is one of the risks that we have to consider, and that means reshoring a lot of the activity that's been going on there. But the real question is what happens in the interim period where we have a shortage, and can we diversify? Can we find other ways to manage or stockpile some of the semiconductors that we need? I think stockpiling is a problem in that field because technology moves so quickly. So stockpiling only works in very stable commodities that don't change over time. That's not the case with things like semiconductors. There is from what I mean, I might be wrong. I have to caveat that I believe I read that there is some stockpiling that goes on with semiconductors, but it's not like of the level that you can have in commodities. That said, in terms of the bigger risks, I think also what happens to the global economy if doing business with China becomes impossible in its own right. If the conflict really escalates, I mean that is, I mean it's a decoupling, but it's more than a decoupling. I mean China is dependent on resources from the West as well, so there is a symbiosis that I think will have to continue no matter what. But if there is a cold, obvious severing of the relationship between the West and China, it's not clear to me who could easily come in to cover the manufacturing and all the provision of goods that comes from China. It would be incredibly hard, and I mean I'm pausing because it's hard to articulate the scale of the problem. It is a very big problem, right? That said, every problem is an opportunity, and over time, it pays to then invest. I mean, from a market investment opportunity, investing in homegrown talent and homegrown manufacturing, that is really the opportunity on the table. So like with, I wasn't around during the Second World War, but it is that sort of opportunity to invest in your own resources, in your own people, in your own manufacturing hubs. And I think it's a question of whether you read it right, because if globalization is going to continue, that's going to be a wasted, sunk capital cost. But if you call it right, it'll be incredibly beneficial. So, and you will do very well. So the risk is there, but that's the nature of markets. So I hope some people are taking that risk because it's good to hedge your bets, as they say.
Now, China has been a first mover in introducing a state-backed digital currency system, a central bank digital currency. And just more recently, the U.S. Federal Reserve has published at least their first paper on the subject, saying, hey, what would a digital dollar look like? What would it mean? So it seems that China is leading the way toward getting governments interested in this idea of coining their own digital currency. Where do you see this headed? And is China's move to outlaw Bitcoin mining likely to spread elsewhere as other governments embrace CBDCs?
So I think that is already happening. I think this year has shown, we're only in January, well, it's February 1st today, but we're only at the start of the year. And I think there's already been a very obvious declaration from the powers that be and the authorities and the central banks that this is the year they're going to come for quick crypto, whether it's in the UK on the regulatory front on advertising or how you promote cryptocurrency, or whether it's a more concrete sort of ban as per China, throwing out the miners. It's clear the sort of party days of crypto are over. Things are going to be cleaned up. The regulatory space is going to become clearer as a result. In some ways, that is a good thing, because the crypto industry has long been saying that uncertainty is one of the biggest problems. If you're going to clamp down, just tell us now, because the bigger risk is over-investing into a field that you are not sure how the regulatory environment is going to end up looking. On the other side, like, crypto has the money it's made. They've invested a lot in public lobbying, and there are a lot of political representatives who are fighting the cause, the crypto cause. Here in the UK, we've had a number of high-level politicians sort of openly opine about the need for the UK to be front and center of the new crypto fintech scene. But what's going on in the sort of crypto and distributed decentralized situation is naturally going to be, I guess, in conflict with what the central banks are doing. The central banks want to move ahead with a CBDC, and they see it as their duty to create a sort of public good, a digital public good that can be used to compete with, like, say, private sector challenges like Libra or Diem as they became known. So their motivation, when you question them, what they say is the reason we're moving ahead with this is because the digital currency space shouldn't be dominated just by private organizations. There needs to be a public option on the table. And I think that is a fair and noble kind of justification for bringing CBDCs. But it's not really foolproof, because the real reason to bring this, to bring about a CBDC is efficiency, and whether or not it'll actually be less costly than, say, the pre-existing system. And where we've seen central banks bring these things to, there hasn't been that many pilots, but where there have been pilots, there's not really been a massive improvement in terms of financial inclusion, or in terms of, privacy, or in terms of efficiency or cost. And that's my big fear, is that this is a bit of a smokescreen for the fact that actually governments are very keen to integrate all the data that comes along with CBDCs and use it to better sort of enforce their tax take and such matters. Which, it depends where you. I'm not in any shape or form defending those who cheat their taxes, but I personally feel that I don't want to live in a surveillance state, and I don't like the sort of slow creep towards a system which is all encompassing and where the state knows every single one of your purchases. That I find quite just like, we live in a democracy. It's fine at the moment, but you never know if things go authoritarian. And I think, you never know, is my point. If things go authoritarian, that is a huge power to give to an authoritarian state that you cannot control, right? So the Nazis, I hate to invoke the Nazis. One should never invoke the Nazis. But I think from a market structure perspective, what is interesting with the Weimar Republic is that they centralized all their communications systems. And that was super efficient and great under Weimar. But it also handed a massive power to the Nazis when they took over. And that is the risk of a CBDC. Yes, it's great if you trust your government and you don't mind sharing your data, but there is no way the government can maintain a CBDC and protect your privacy. It's just not going to happen, because the two, it's a paradox. You cannot have a CBDC that is AML KYC compliant, which is what it would have to be, and private at the same time. The way they've tried to manage that risk is by sort of saying, well, we'll allow privacy for small transactions. So we'll only take your details if it's like a transaction that is more than £1,000, dollars, right? And that's the way the Chinese have approached the quandary as well. But overall, I'm still not convinced, even on this. I'm still not convinced that's a good thing necessarily, but that's my own personal subjective take.
Well, Izzy, we were in total agreement until you said you just don't know if it's going to go authoritarian. I think we do know, and if you don't want to live in an authoritarian society, I think you better hope Elon gets those rocket ships to Mars working, because this planet's headed in an authoritarian direction. I think that's pretty darn clear, unfortunately, and I sure hope that I'm wrong about that. Let's move on, though.
That's interesting. I mean, I'd love to. I mean, I was trying to be guarded, but I tend to agree with you. I think there's been a massive move towards the authoritarian side of the equation, and I don't want to. One has to be careful what one says these days as a result.
Well, and certainly, there are plenty of people who think that these times warrant having authoritarian governments and that that's better. And of course, that's, we say there's takes two views to make a market. I suppose it takes lots of different views to make up a society. Let's keep this podcast focused on the markets, though, and go back to these technology developments. You've also written a fair amount about a different trend. A lot of people think that these automated business models where you get something like Uber, where basically the whole thing kind of runs on the computer and makes lots of money for the owners and doesn't require a lot of labor other than the Uber drivers who are independent contractors and don't get paid very much. And Uber itself was supposed to just be this incredible profit child. You were one of the first people to kind of call that out and say, wait a minute, I'm not so persuaded about their business model. You said both Airbnb and Uber probably are not what they're cracked up to be back when everybody thought they were both great. So it looks like your view has kind of been proven out on Uber, Airbnb. I'm not sure. How's it doing?
On Airbnb, I think anecdotally, I've been proven right. I think a lot of Airbnb hosts have pulled out of the market, in especially when they've had lets that were focused on tourism, on international tourism. That hasn't done very well for them, of course, because of coronavirus. On the flip side, we've had a boom in stay-at-home type properties. So in the UK, the Airbnb sector has benefited massively from the staycation with, in the countries, the people who have like lets in the countryside. On a share price, so that they went public on NASDAQ in December 2020. Share prices been a bit volatile, but mainly plateaued. And they reported very strong Q3 numbers in the last quarter, with profits surging about 280%. So it does look like they're profitable. So I guess what I would say is that I was right on a sort of anecdotal, personal level. It's incredibly sensitive to the macro conditions, and coronavirus has in many ways helped to support what Airbnb is. But in terms of, I was perhaps a little bit too gloomy about their profit potential. They are making profits, and I think the difference there is the rentier part of the model. It's just much easier to get a rent out of a profit out of a rentier based system than, say, a labor intensive one like Uber or Deliveroo or any of the other kind of gig economy acts.
Let's talk about what happens next in this recovery, specifically with regard to international travel and the attitude of consumers, because something I've read, a view that I've seen by quite a few different people and at quite a few different places, goes like this. Look, personal savings have been drawn down. A lot of people got laid off during the pandemic. They're tapped for savings. Nobody's got any money. What you can expect is that as stimulus starts to get withdrawn, everybody's going to be out of money. Nobody's going to be spending money on anything. It's going to be really kind of tough times for the economy. I have the exact opposite view, Izzy. I think that what's happening here is the whole world has been cooped up for 2 freaking years in a pandemic that's got everybody at the kind of the end of their emotional rope. And whether they have savings or not, if they have access to credit, my prediction is people are going to go party and travel and vacation and make their first international trip if they've never had one before, and really, really travel like they've never traveled before. That's a complete gut feeling on my part. I'm not backing it up with any real analysis. What do you think? I mean, where are we headed in terms of how this recovery goes? Is this a consumer that's ready to spend?
I think there's I think the key word to bear in mind is segmentation. So I think I'm instinctively in your camp. I think there's been a repression the last 2 years, and when restrictions are lifted, those who can and those who are not fearful are going to go crazy and really compensate for the repressed times. And I think, we always talked about Chinese repression and the repressed markets over there. And certainly the logic for many years was like, if you release the restrictions, the Chinese consumer will go and the investor will go nuts, right? And they kind of did. So I think that is likely to follow in a similar vein on this front. That said, my caveat is that I think there is still a lot of fear out there. I think the there's going to be a sizable component of the population that is never going to travel the way they used to, and is still not just fearful of catching coronavirus, but the burden of all the forms, the documentation, the bureaucracy. Even if some of that is lifted, unfortunately, I think a lot of that is here to stay for the long term. I think masks on airplanes are going to stay for a long time. There's going to be a lot of conventions that are going to be very hard to get rid of. And for me, as a mother of a 4-year-old, I'm not going to do a transatlantic journey with a 4-year-old wearing a mask, because for me that is well, you don't know my 4-year-old. It's just not going to happen. So those are the sort of considerations that I think will continue to repress some of the recovery, and until it might take a generation before that sort of thinking is reversed, frankly. So I really do want to be hopeful, and I think the younger generations are going to make up for it, but the younger generations don't have the access to credit and the income that the older generations do, and that's really where the big spending, especially in the tourist and leisure economies, was coming from pre-COVID, right? So with a more muted sort of retired section of society, especially as their demographics become more and more dominant on that side, I think the balance will be a kind of maybe I'm not sure. I mean, and that's really the argument against inflation as well, for sustained inflation, is that even if we have to, even if supply chain crunches continue on, there might still be a muted demand from the West. But on a global level, I think we still have to, remember that the demand from the emerging economies is still growing. It was growing all the way through coronavirus, and even in the midst of lockdown, yes, there was a localized cut in consumption, but on a global level, consumption of energy was still, don't get me wrong, demand did fall, but it bounced back pretty quickly. So yeah, I think we have to look at the big picture, and the big picture is that demand is going to be forthcoming. I agree with you, but the exit of the older generations might be a problem.
Izzy, I want to commend you because, I follow a lot of different writers on the internet, whether it be the mainstream or the blogs and what have you. The work you've done for Financial Times Alphaville blog is some of the best writing that I've seen anywhere on the internet. You and I met back in 2012 or 13 when you wrote a piece about collateral mining, the practice that banks were engaging in of taking advantage of extreme contango in the futures market in order to replace Treasury collateral because of the extremely low yields that existed on T-bills at the time. And I just thought that was a really insightful piece of work, and I've been following you ever since. Something must have changed because you're leaving Financial Times Alphaville, which has a terrific reputation, to do your own thing. Why are you doing your own thing? What is the impetus for theblindspot.com, and what are your plans?
Thank you so much for those kind words. I really appreciate them. So I guess the most diplomatic way to say things is that sometimes when it comes to innovation and experimentation, you can't do it within a large organization. Like this isn't specific to the FT. I think there are sort of bureaucratic forces that are very risk averse and all over the place, right, at the moment. And this tendency to be incredibly cautious when it comes to innovation prevents experimentation, especially online, and especially in sort of trying to approach things in a more, well, I don't want to say whimsical, because I think we, on Alphaville we knew how to have a laugh, but we were also very serious when it mattered. But I think it's important to be able to I think it's important that to be.
Would it be fair to say, Izzy, that you want to break free of being afraid to tell our listeners that you think the world is turning authoritarian, like happened just a little bit earlier on this broadcast?
So yeah, I think there is this. Unfortunately, I do think there are forces that are beyond the control of any one journalist or editor that are edging the world towards authoritarianism, and I think it's important for disruptors to be able to challenge those forces. And I don't think it's like the Brexit debate. Many people said, well, you have to stay in the, if you don't like the sort of centralization, bureaucracy, you still have to stay in the club to be able to influence it, right? But then at some point, a big faction of society said, no, it's gone. We can't influence it anymore. We've got to go outside and do our own thing and lead by example, right? So it's a bit like that. I'm not saying I'm Brexiting the FT, but
sounds to me like you're the Joe Rogan of the FT. You're ready to break away from the mainstream and tell people how it really is.
Well, it's more that I think to really be creative and innovative and to push the boundaries, I think you have to be independent now. And who is, what does independence even mean in media? It's really hard. It's really hard to remain independent because at the end of the day, you're always going to be under the thumb of your paymaster, whether that's your readers or whether it's a sponsor or whether it's a corporation or some billionaire, right? So I think you have to be on your toes, and I think you have to move around. And thankfully, the structure of the internet is such that there's never been a better time to go off as an individual and try to create your own brand. So I'm going to give it a stab because I think that's the future. And I think, I might massively fail, but we need to continue innovating, and we have to, sometimes things have to happen off balance sheet, basically, is what I'm trying to say.
Got it. Well, Izzy, that was extremely diplomatic, and I'm sure that the Financial Times lawyers will be satisfied. Now, since my job on MacroVoices is to summarize what the guest says for our listeners, folks, you can't go to Izzy Says What She Really Thinks and the hell with the FT editors and their bureaucracy.com because, well, the Brits are a little bit prone to understatement, so you got to go to the-blindspot.com for that same content. Patrick Ceresna and I will be back as MacroVoices continues right here at macrovoices.com. I've talked with several guests about topics like inflation and fears of a market correction, and those are real concerns for many investors. I'm sure many of you are wondering where to put your money. Many investors are turning to alternative assets for protection. You could look into traditional assets like gold, real estate, and bonds, but there's one unexpected asset everyone's talking about lately: blue chip art. Its growth has outpaced the S&P 500 from 1995 through 2020, and it has almost no correlation to other asset classes. In other words, its value doesn't drop as much as other investments when markets crash. Most people don't realize you can now invest in million-dollar art by Banksy, Monet, and even Picasso. To discover how to access this asset class, visit masterworks.art/macrovoices. That's masterworks.art/macrovoices. See important disclosures at macrovoices.io/disclaimer.
Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Erik, you really got Izzy talking some fun topics. What did you take away from that interview?
Well, I'm really looking forward to her blog. I have a feeling she's got a lot to say and hasn't been able to say it, and we got her to come out of her shell a little bit at the end there. So I'm looking forward to her first few blog posts. But in any event, Patrick, I want to move on to our post-game chart deck. Listeners, you'll find the download link in your Research Roundup email. If you don't have the Research Roundup email, it means you're not yet registered. Just go to our homepage, macrovoices.com, click the red button that says Looking for the Downloads. Patrick, chart deck says Update on the bond markets. Let's dive into it.
Yeah, well, I just wanted to quickly talk the charts on equity and crude oil before we get into the bond markets. But what I wanted to just touch on in the S&P 500, so we basically had a 300 S&P point whip from the intraday low to the high as we saw a meaningful rally. And the question is that enough to make it a bottom? And there's that old adage on there that the rallies in the middle of bear markets are often the most violent. And I'm not trying to call this a bear market, but it's simply pointing out that the magnitude of the rally to the upside has been directly proportional to the speed of which the stock market declined throughout January. So we've now approached a 50 to 61% retracement of the entire drop. And we're now entering a phase where we're going to find out whether this was exactly what that is, a bounce, and the market has more downside upside to come, or is the bottom actually in? And I don't know if I want to stick my neck out and make too bold of a call, but right now, what we really want to see is as we sell today and go into maybe some selling tomorrow, will the buyers hold the line and buy the dip? If we see that the selling accelerates and we see that a new sell cycle has begun, we could easily be finding ourselves double bottom testing the 4,200 level, or even a breakdown to 4,000 could be in store. So it'll be a really interesting next week to watch. One of the things on page 3, when we look at that volatility index that we were highlighting, was a lot of that violent rally comes from the volatility contracting, or what's known as the Vanna influence on dealers. And what we saw was a collapse in volatility where we were as high as the 38 level the other week and find ourselves all the way back down toward the 20 handle during the collapse of volatility. And that really contributed to slingshotting the stock market higher. But the question is that now fully out of the market, and is now volatility going to return later this week or into next week? And it's certainly something on my mind.
Well, Patrick, I agree. And the thing that I would say here is do not assume that just because we've had so many retraces to all-time highs against all odds, it would seem, that it has to happen again this time. It really does feel to me like we finally have a little bit of this time it's different, in the sense that the Fed, regardless of whether they're really going to stay the course or not, at least for a while, they have to. And I think there's room for this market to be dragged further down. In any event, let's move on to page 4 with crude oil futures. What's going on there?
Well, we obviously had a pop toward $90 on the OPEC news, and it quickly market receded off of the initial positive reaction, putting in a doji candle, which is an indecision candle. And the one thing that I continue to highlight is that irrespective of my bigger picture bullish tilt on oil that could go higher, I continue to be of the position that this is way overdone on the short term. And I'll show some different stuff on the energy markets in a moment. But I'm wondering whether the OPEC becomes a short-term swing high. At some stage, a $5 pullback in crude oil or more toward $80 would be an incredibly natural pullback. And we'll certainly see whether in the coming days, whether this is where the market turns or whether the bigger, more prevailing bull trend just keeps trucking along. What's your take on the oil markets here?
Well, Patrick, normally I would agree with everything that you just said, which is to say we've had such a huge run up, we're way overdue for a $5 or even bigger, maybe $5 to $10 pullback. The thing is that there's still really tight physical market in Cushing, Oklahoma. I'm looking at the explosion today of the March to April time spread on WTI, back up at $1.85, almost $2 for 1 month worth of backwardation. That's really extreme backwardation, and it indicates tight supply. So on one hand, this market's way overdone, and if something changes, there's plenty of room for a really big pullback. The thing is, so far, nothing's changed, and what we've got is a really tight market. We've got the escalating situation in Ukraine and so forth, or perhaps it's de-escalating for the moment, but I think it's got more escalation ahead of it. And just as we're speaking, actually, ironically, as you were saying the words that the market tested almost $90 the other day on OPEC, we actually traded through $90, looking at 90.20 as we're speaking right now. So it looks like a break higher after that indecision candle may already be upon us. And again, I think we can get a couple more dollars up here, 92, 93 maybe. At some point, there has to be a big pullback, but not until this tight physical market gets resolved.
That makes sense. It's interesting to observe what's actually also happening in the energy sector ETF, or generally the basket of energy stocks. During this entire market pullback, they have been one of the few sectors that continues to work. Every pullback is almost immediately slingshotted higher, and everyone is grabbing at and chasing the energy plays to the upside. What is interesting is if we go to page 6, where I have the energy sector bullish percentage index, which is measuring how many of the energy stocks are in bull trend, we just hit 100%. And what is interesting is that over the course of the last 2 years, we've seen the energy sector hit this 100% mark on 5 occasions. And on each of those occasions, a market correction did ensue at some point. So while I do agree with you that there is still a tight oil market, and that certainly can drive short-term strength in this trend that is just so dominant, but there is probably not much asymmetry in grabbing at this. Look, if you've been in the energy market for the last few months, congratulations, you made some great money. But this is the wrong time to chase, in my opinion.
I would definitely agree with that, and there's plenty of potential here for this to go either really hard up some more or reverse down hard. And I agree for that reason. You don't want to be chasing it with new longs here.
Oh, you know what? Maybe we should straddle it up a little bit, eh? Anyway, so I want to touch on the euro and particularly what's happening in the bond markets. On page 7, last week we were highlighting the breakdown in the euro, but after a little bit of a bounce, the ECB press conference and release just slingshotted the euro higher. And so while we've seen that dollar index weakening, it really has been a euro story. While the currency has made a meaningful break, what is more interesting is what has happened to the German government bond yields, the 10-year one on page 8. And for the first time in what was almost 3 years, we suddenly have seen a positive yield on 10-year government bond yields in Germany. We've crossed the zero line, and I think it's pretty significant because we've spent so long in negative interest rate territory there. I'm curious whether or not this is a sustained new trend and whether this kind of bond bearishness continues in the bigger picture.
I'd love to get Jim Bianco's reaction to this chart because you're exactly right, Patrick. We would have told ourselves that negative sovereign yields, especially on a major industrial country like Germany, were impossible just a few years ago. And of course, we've proven the impossible possible. Is that era of history over, or is this just a little blip and we're going back to that? Going to be very interesting to find out.
Yeah, what I want to move on to here is just take a walk through some of the different parts of the bond market. Here I have the TIPS bond ETF, and what is interesting is that this has been a very weak part of the market. A lot of people have been grabbing at TIPS throughout much of the last year or two to get some inflation hedge into their portfolios, but really it's now given back almost all of its 2021 move. Obviously, you carried a yield during that period, but at least from a price perspective, we find ourselves back down to the March 2021 lows, almost like it's just really interesting to see that the TIPS have been this very weak.
Patrick, on page 10, we've got the ProShares Inflation Expectations ETF. Let's explain what expectations means and how that fits into this ETF and what it does.
Well, it's basically a call on what the market is pricing 30-year, in this particular case, 30-year inflation expectations of what is going to be inflation moving forward, not just what it is today. And what we continue to see is that the marketplace simply is not worried about secular inflation. And what we continue to see is that we're now trading at close to like 9-10 month lows, or at least testing the supports of those 9-10 month lows on inflation expectations here. And it's just really interesting to see that with crude oil ripping higher the way it is and inflation printing as high as it is, this is simply not manifesting in these longer term expectations. Erik, so I want to move on, though. When we look on page 11, I wanted to highlight just how weak global bond markets have been, right? I mean, we spend so much time staring at what's been happening on that 10-year U.S. Treasury yield. But when we look at the emerging markets bond ETF, and this is the emerging market bonds that are priced in U.S. dollars, just have been in a sustained downtrend. And the continued weakness, every rally is failing, just continue to deteriorate. And so while we certainly are highlighting that the bond markets in the U.S. are under stress, it is really a very broad story. And a lot of the world bond markets remain incredibly weak in this period. And in fact, I would almost argue that in many ways, U.S. bonds are not remotely as bad as some of these emerging market ones.
Patrick, let's move on to investment-grade corporate bonds on page 12.
Well, you know what? I just also wanted to highlight just that finally we are seeing the credit spread starting to blow out on these investment grade bond weakness that we've seen. So we have seen both in junk and in IG bonds a downtrend, but the downtrend was very much being driven by the entire interest rate complex rising and subsequently all bonds weakening. But we were waiting to see when the credit spreads, nonetheless, on these corporate bonds would start to rise, to start to show that there might be stresses in the space. And what's interesting here is while I don't have the junk bond one here, the corporate investment grade credit spreads have actually now broken to a year high. And it'll be really interesting to see whether this starts a new trend, because usually when these things start to blow out, they really start to run on the upside. Are we seeing the cracks in the corporate bond market here? It's going to be really interesting to see.
Listeners, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. Information is on page 14 and 15 or at bigpicturetrading.com. We're going to leave it there for this week's show. This episode is brought to you by Abex Technologies, pioneering the design of smarter markets that better serve the needs of both market participants and society as a whole. And by Masterworks, the billion-dollar alternative investment platform that lets you invest in art by legends like Warhol and Picasso for a fraction of the cost. Patrick, tell them what's in this week's Research Roundup.
Well, this week you're going to find the transcript for today's interview as well as a link to the chart book we just discussed here in the postgame. There's also a number of links to articles that we also found really interesting. So you'll find this and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter @Erik S. Townsend. That's Erik spelled with a K, and myself @Patrick Ceresna. On behalf of Erik Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.